Edge Designations, Chi Level 1, Topic 2, Introduction to Alternative Investments. This is the third reading or third chapter in Topic 2, Reading 2.3, Accessing Alternative Investments. Let's get ourselves going straight away into this particular reading. It's a lovely reading. In fact, they're all lovely readings. Let's get going straight away. And what you'll notice is that there are components of this reading. I'm talking particularly to those that were 2023 candidates and are now moving into 2024 for whatever reason and are still doing Chi Level 1. You'll notice that this wasn't a specific reading that we had in Topic 2 in 2023. It's a new one. When I say it's a new one, what that really means is that we're pulling stuff from all over the old syllabus into this new reading here. It's not completely new, but yes, it is a new reading for Topic 2. On that note, let's get ourselves going straight away. Let us have a look. Okay, as per usual, we've got all the learning objectives on the very front page of the document, as you can see over there. Okay, let's just put that there. Here's the learning objective 2.3, accessing alternative investments. And as we can see over here, we've got 231, 232, 33, 34, 35, 36, and that's where it ends. Okay, so 6 learning objectives to cover in reading 2.3, accessing alternative investments. Let's get going straight away, and let's start with the very first one on page 231. Demonstrate knowledge of the 2 main fund structures used for alternative investment funds. And we start off over here, we've got what they call open-end or evergreen fund structure. Now remember, if it's open-end, there's no specific close point, okay, and I suppose the term evergreen bears that out as well, okay. And in order to give us a little bit of a structure in terms of open-end or evergreen fund structures, okay, let's look at some of the elements that are common to these types of structures. New capital can be invested anytime throughout the life of the fund. And then as soon as new capital is issued, okay, new shares, okay, are issued, okay, and obviously that's the number, the value won't increase much per share, because all that you're really doing is you're issuing new capital, but you're issuing new shares for that new capital as well. The per share amount should remain the same. Capital can be redeemed at any point in time during the life of the fund. Redemptions are done on a per share basis. When the fund starts initially at inception, the fund has got what we call an indefinite lifespan, hence the term evergreen or open end. Okay, and just like most funds, the fund charges an asset-based fee, okay, as a percentage of assets under management in order to manage the funds. In addition, there is an incentive-based fee as well if the fund performs over and above a certain benchmark over the time period. Okay. A high watermark structure is used, and now we start to see the terms high watermark. High watermark means that, and this is obviously often a concern that often investors have, okay, that it's not fair if the private equity, hedge fund, whatever fund it happens to be, in year 1, okay, will take a specific performance incentive, okay, and let me just draw us a little picture for that, because it does make it look so much nicer on a picture. So let's have a look over here. Okay, there's time period 0, time period 1, time period 2, and let's even go to time period 3. Now, time period 1, the fund did fantastically well, beat its benchmark, and the fund was entitled to what we would call an incentive amount, some kind of incentive-based fee, some kind of carried interest. Okay. In year 2, they did very poorly. Okay, and obviously that no one was calling for bonuses or carried interest in year 2. Okay, and the reason for that, of course, is because they did so poorly. In year 3, they did better again. Okay, Now let's have a look. In year 3, what does the management team, what might the management team ask for? They may say, hold on a second. In year 2, we were there. In year 3, look at the returns we've managed to achieve. We would like an incentive fee for that. The answer to that is no, and the reason why, let's have a look. And this is what we're going to call a high watermark structure. High watermark is, let's go to the last point or the highest time, that the highest return that this fund has achieved, and I'm going to draw the line for you there. Hopefully it's accurate. There we go. What we see over here, that this point over here is what we would call the high watermark, and until such time as the fund achieves over that point, they are not entitled to incentive fees at all, because they've already taken incentive fees up until that particular point in time. So when, yes, in time period 3, they say to you, well, we've done so well, we've taken you from losses over there to gains over there in time period 3, the answer still is no incentive fee until you get above that particular point and above. Okay, here we go. Certain open-end fund managers prohibit investors from redeeming capital for a set period of time after the initial investments are made, and obviously the reason for that is to try and make sure that the fund has got use of the capital for a set period at least, okay, and they're not worried that there will be redemptions early on in the fund, which will make managing the fund quite difficult. We've got 2 kinds of lockups, in other words, periods that investors cannot take their money out during. Hard lockup or soft lockup. A hard lock, okay, will prohibit investors redeeming capital during the period. You cannot get your money out during the lockup period. No exceptions. A soft lock will allow them to redeem their money during the period, during the lockup period. However, there is a bit of a caveat over here, is there might be some kind of a fee or some kind of a payment of a penalty to tell them, listen, yes, you can take the money out, but there is going to be a little bit of a penalty for you doing that. Okay. We've got another term over here, gates. What's a gate? Okay, a gate. Okay, they are fund restrictions on investor withdrawals. They come generally in 2 forms. Form number 1, at an investor level, in other words, restricts the amount of capital, okay, an investor may withdraw at any point in time, okay. And then we've also got fund level gates. And what are fund level gates? They restrict the amount of capital that can be withdrawn from the fund as a whole, okay, during a certain given time period. Okay, those are 2 different gates, just another way to restrict withdrawals. We've also got interval funds over here onto page number 3. What are interval funds? These are semi-liquid closed-end funds. They don't trade on the secondary market, okay. However, there is option for investors to exit their funds or to withdraw their to make redemptions at certain, they're called intervals. That's why they call it at regular intervals. Investors are able to get out of their funds. Investors can purchase these funds at the regular net asset value, okay, even as often as daily, okay. I mean, in most cases, there is a low minimum investment. In other words, not so difficult to get in because the minimum investment is not so high. Okay. Closed-end function, and you can see we work predominantly with 2 kinds of structures, open-end and closed-end, and you can see closed-end will have almost opposite features to an open-end fund, okay. They're quite illiquid, okay. Let's have a look at some of the features that are specific to closed-end funds, okay. They focus on private or illiquid securities in most cases, okay. They're often referred to as a drawdown or a private equity styled fund, okay. How would it work? The fund will raise a set pool of capital, however much they're looking to raise during their fundraising exercise, and being a closed-end fund, no further capital will be raised, okay. Investors, and guys remember, okay, investors are generally referred to as limited partners. They'll commit a set amount of capital, okay. We do see a distinction between a closed-end fund and a drawdown private equity style fund, okay. A closed-end fund manager may request all the capital that's been committed by the limited partners on day one. Whereas drawdown, look at the words drawdown, they'll draw down over a period, or private equity style. Generally, there'll be a large amount of capital committed by the limited partners up front. That's called the committed capital, and they'll draw down on that amount as they make investments into the fund. Okay, closed-end fund structures, it's got a fixed lifespan. Okay, investments can only be made during a set investment period. Investors may not redeem capital, and capital is only returned once an investment or once the fund has been realized. Management fees, this is typical with a private equity type structure, is charged on committed capital. Okay, sometimes could also be on invested capital. And again, incentive fees are charged when investments are realized and capital is distributed to the investors. Okay. We talk about blind pool equity fund. Okay, and what is a blind pool? Okay, and look at the words again, guys. As much as you can as you go through the CAI syllabus, there's going to be a ton of words that we maybe not familiar with. Okay, we've got to start to learn to understand what they're talking about as opposed to learning stuff too much off by heart. When we see the word blind pool, okay, that generally speaking, the limited partners don't really know what will be invested in per se. Okay, as you can see over here, the investment mandate generally does not involve the limited partners in the deal sourcing. They don't know really what's going to be bought, what's going to be sold. Remember, that is the job then of the general partner or the management team. The limited partner generally does not get that involved in that. Committed capital, we've spoken about, that's the amount of capital committed by the limited partners or the investors to the fund. And a capital call is when the general partner or the manager calls for that funding from the limited partners. Okay, and of course, the amount that they are allowed to call or they can call is limited to what has been committed. Okay. We look over here some of the risks of private equity fund structures. Okay, market risk, and we all know market risk. Market risk is the risk of prices moving against you. What type of prices are generally referred to when we talk about market risk? Just something important that we were familiar with. Okay, the following prices can move against you: share prices or stock prices. Exchange rates can move against you as well. Interest rates can move against you, and commodity prices can also move against you. This is obviously a bigger market risk, is often a bigger risk with private equity, is because you can't get in and out of the investment so easily due to a lack of liquidity. Okay. Second big risk is what we call funding or commitment risk. Okay. And remember, when a limited partner commits to capital over a certain period of time, they're never really sure when the general partner, okay, or the manager is going to call for that money. It's unpredictable over the commitment period. Okay, and remember, generally speaking, and I'm talking from experience here, okay, the time period given to the limited partner to get that money together is quite short. It's normally about 7 to 14 days. Okay, that's called funding or commitment risk. Liquidity risk is fairly simple. Okay, is that you may not get the full value of your asset when you're trying to sell it because there's not much liquidity in the market. There we go. Realization risk. Okay, what is, and look at the words again, guys. Realization. Okay, that the invested capital will not be realized or returned to the investor or the limited partner. Okay, and could well be that there are unprofitable investments, okay, in the particular fund, or the general partner may not be able to exit these funds profitably. We turn to page number 4, strategies to mitigate private equity risks. Let's look one by one. Market risk mitigation. How would you mitigate market risk? Okay, generally we talk about mitigating market risk by building a diversified portfolio of private equity funds. How do you mitigate the risk of liquidity? often what one needs to make sure that the fund has got sufficient resources and exposure to other liquid assets, okay, in addition to what they are currently holding. You've got funding risk mitigation, okay. How does the limited partner make sure that they're going to have sufficient capital available when money is called from them, when there's a drawdown request? Well, they can cap the amount that they want. They can cap their original capital commitment amount just to make sure they've got sufficient available. How do you mitigate realization risk? Again, by building a diversified portfolio. Okay, and then hopefully you will have more winners in there than losers. Okay, and you'll skew the overall portfolio's performance towards positive returns. We have a look over here, hedge funds versus private equity funds. How do they differ? Okay, and if you remember, if I just take you back, I'm sure everybody remembers back to the very first chapter reading of topic 2, Intro to Alternatives, which was 2.1. There we saw, and just you guys have got to keep on going back, revising, and always remembering what we saw previously. We saw that over the last approximate 10 years, hedge funds have had a massive dip in investment, as opposed to private equities who have had a massive increase in investment. Okay, so hedge funds are finding a lot of competition out there in the market. Okay, and vice versa as well. Some of the advantages that hedge funds have over private equity funds would include, let's have a look over here. Private equity incentive fees normally are based on realized profit. In other words, an investment has to be sold, as opposed to for hedge funds, where we really just look at the changes in the market value. Okay, hedge funds don't typically have a clawback provision. In most cases, you would find that private equity funds do have a clawback provision. The hurdle rate required by hedge funds is generally lower than private equity funds. Number 4, hedge funds incentive fees are front loaded. Okay, similar to what we saw previously. Okay, on point number 1, private equity fund that really get the incentive fee at the end. Point 5, hedge fund incentive fees are collected on a regular basis, whereas normally that's an annual basis. Private equity fees are received again when there's been some kind of an exit, either of the total fund, which will be fund as a whole, or on a deal by deal basis, but again, once an investment has been sold. Similar point in point 6, hedge fund incentive fees can be paid out before anything is paid across to the limited partners, whereas private equity funds require capital to be returned to the investor first. Remember the drawdown structure that we saw previously. Who takes first? Okay, within a private equity context, generally the limited partner gets their capital returned. The limited partner then will also take a little bit of a hurdle as well, a kind of like an interest type charge, and only then will the general partner or manager participate. Over our page, top of page 5, we talk about demonstrate knowledge of liquid alternative investments. And now that concept might seem a little bit foreign. How do you get liquid and alternative investments in the same statement? Generally, when we see the characteristics of alternative investments, they are lumpy, illiquid type of investments. Okay, but now let's see over here. These liquid alternatives, why are they there? They came about as a result of the shortcomings that are generally related to alternative investments, including what? Tradability, lack of transparency, and particularly, guys, illiquidity. Liquid alternatives are traded on an exchange and are more liquid and available to retail investors. Okay, as a result of that, okay, their fees tend to be a little bit lower. A nice example of a liquid alternative is a REIT, a real estate investment trust, okay, which is a liquid investment and it allows for liquidity and investability by smaller investors. Okay, liquid alternatives, where would you find them? They are governed under the US, in the US under the Investments Act of 1940. In Europe, they are covered by the UCITS directive. Some things just to have a look over here. Okay, some constraints regarding liquid alternatives, diversification. Okay, per regulation. Okay, it must be at least 50% of the fund's assets must be invested in diversified investments. So it can't all be in one specific asset. Leverage, we've got a leverage ratio of 3. Okay, and how do you calculate leverage? It's a lovely little ratio. Please know it, guys. It's assets over net borrowings, because your assets, remember, if we say assets over net borrowings, okay, is a ratio of 3. That would mean, what does that mean? That means that you've got 3 times more assets than your borrowings. Okay, you can just see that from that ratio over there. Liquidity, okay, liquidity is limited to 15% of the investments portfolio. And guys, when you see these numbers, please don't just turn the page. A lot of people like to turn the page. They don't like such detail. Remembering again, guys, Kaya loves detail. I hope you like my... Okay, Kaya loves detail. Okay, just please remember that. And when you see things like this, a leverage ratio of 3 times, a diversification ratio of 50%, a liquidity of 15%, please remember those. Okay, those are very likely to come up in your final exam. Okay, we look over here. Liquid alternatives are more subject to regulation, okay, than traditional hedge funds. Remember, typically speaking, hedge funds are not subject to a large amount of regulation. Okay, liquid alternatives also make use of a closed-end structure. A closed-end structure, we spoke about that at the beginning of this chapter. Okay, generally speaking, liquid alternative strategies include what we call a replication. Okay, which replication means wants to achieve the same returns as whatever is being replicated. We've also got a term called cloning. Okay, cloning, yes, it aims to get to a similar kind of a return structure, return picture, but it aims to copy the strategy of the fund, whereas replication wants to get the same returns. Doesn't necessarily have to use the same strategy, but it does want to get the same returns. So that's then the difference between cloning and replication. We look at the following fund types when investing in liquid alternatives. Skill-based replication products. Remember again, guys, replication, we want the same returns. Okay, but you don't necessarily have to employ the same strategy. Okay, and you may be using a complex strategy, but you just want to get the same returns as the alternative investment. We've got liquidity-based replication products. Okay, in other words, we are trying to replicate the returns of a liquid investment, okay, that's got the same characteristics as the illiquid investments that I've got in my alternative fund. And those were both, remember, those were both replication. Replication, I just want to get the same return. Cloning, constrained clones, I'm using the same strategy as an alternative fund. Okay. Why is it called constrained? Because it has certain constraints that it is governed by. What are some of those constraints or restrictions? Diversification, perhaps, and liquidity. Why do we have restrictions then? To limit the overall risk. Top of page 6, we see over here, we've got unconstrained clones. Okay, again, guys, remember the word clone. Clone means it's going to do exactly the same strategy, but here it's unconstrained. There are no constraints such as diversification or liquidity. And then we've got diversified or absolute return products. Okay, and diversified means a lower level of correlation with traditional. Okay, and because it's got a lower level of correlation, it will be more diversified. Liquid alternatives have grown over the past period, and why is that so? Okay, generally we've seen low bond returns, and generally people are experiencing equities to be slightly overvalued, but they still want those characteristics of liquidity that pertain to equities and fixed income. So if you can offer them liquid alternatives, you are offering them something that they are looking for. the market has shifted from benefit plans to contribution plans. In other words, remember, when you move from a benefit plan to a contribution plan, the risk of that investment now all sits with the investor. The investors are now looking to earn a better return in their particular investment, so they're going to be looking to things like liquid alternatives. What are some of the returns? Liquid alternatives are driven by two key components here: manager compensation and investment action. Management compensation, okay. Liquid alternatives do not provide for incentive fees, okay, even when large profits are being made, okay. And generally speaking, what you might find that liquid alternative funds tend to attract less skilled managers. And why is that? Because the more skilled managers are going to say, what? I don't want to sit over here and be subject to no incentive fee. I want to be in a fund where I can get a nice big incentive fee. So I'm going to go to the illiquid alternatives. Investment action. Due to their high level of liquidity, generally speaking, liquid alternatives do not command a liquidity premium, okay. In addition, in most cases, liquid alternatives are more constrained than alternative investments with regard to what they can be, what they're allowed to invest in. Okay, and the reason is because they are now being offered to retail or small investors. We need to limit that risk. Okay, 233. Demonstrate knowledge of the trend of LP preference for direct investment. So first of all, okay. We need to talk a little bit about direct investments. And what you notice for those that are, as I say, those that have been in the system for a little bit longer, perhaps a lot of the information contained in this reading was previously in the private equity readings and are no longer there, but not completely new, of course. A private equity fund often provides capital, okay, where if you had to go to a more traditional financier, they wouldn't be prepared to do so. Okay, but on the downside, of course, private equity investing is more risky, and based on that, the higher levels of returns are justified. Okay, it's important that the interest of everybody is taken care of, managers, shareholders, etc., in order to achieve sufficient returns. What are the key functions of a private equity fund? Capital is pooled from various investors. They then look for investments in high return companies. Okay, they promote and facilitate the growth and development of this company. Financing is provided as well. They often offer coaching and mentoring to their investee companies to grow them nicely, and then they'd often exit profitably. Okay. And you'll notice we have spoken about a lot of this previously, but let's just have a quick look again. The limited partner is a form of VC or venture capital ownership. Doesn't have to be VC, it could be private equity as well. Okay, and remember that the limited partner provides funding but does not play an active role in the management of the investment. Why is it called limited partner? It's limited because their liability is limited to what they invested in the fund. You've got the general partner. The GP is the manager of the fund and is responsible for all the liabilities of the firm. Generally speaking, we would say that the general partner has got unlimited liability. General partner is responsible for raising funds, and will focus then on extracting value from the fund via active management. Okay, what does active management mean? Generally speaking, what would we say? Okay, they seek attractive investments for the fund. They limit their risk by doing detailed due diligences, and they work with the management team. Hopefully there's a good relationship such that they can increase fund value. Okay, remember, of course, okay, we've got these concepts of moral hazard. Why? Because there is information asymmetry in there as well, and incomplete information, okay, within the private equity market. We did speak a little bit earlier about all the various agreements that need to be in place to protect the limited partner. One of them, just for example, the limited partnership agreement, the LPA, is there to protect the limited partner due to this, what we call information asymmetries, that the general partner knows a lot more about what's going on, and always will, because they manage the funds on a day-to-day basis, than will the limited partner. Generally speaking, doesn't have to be, but generally the life cycle of a fund will run for about 10 years. First 2 years, the managers are raising funds for the investments. Year 3 to 10, funds are drawn down and are invested in profitable companies. Okay, and often during this time period, the companies are exited as well. There are times that there does need to be a little bit of an extension. Okay, another year or two probably at most. Okay. We look at the following main forms of private equity funds. You've got a fund of funds. In other words, the asset owner invests in a private equity fund of funds. And what is that? If you just look at the structure over here, you've got here is the private equity, or what we would call private equity fund of funds. Why is it called a fund of funds? Because it in itself will go and invest in many different other private equity funds down there on the bottom. Okay, then you've just got a stock standard private equity fund, which will be any of these little individuals over there. You've got direct investment. That's where the asset owner will invest directly into a portfolio company. Because remember what happens, and I'll take you one stage down over here with these private equity funds. Each private equity fund themselves will go and invest in what? In different companies, company 1, company 2, etc., etc. Direct investment is where an investor doesn't need a private equity fund. They go straight to the companies themselves. Sometimes they will form a partnership. In other words, the asset owner will form a partnership with other asset owners or a general partner, a manager, to make investments. And you might even get private equity fund with what we call a co-investment. Okay, in other words, the private equity fund says, hold on a second, this particular fund's a little bit too expensive. This particular investment might be a bit expensive for me to invest in. Let me look for co-investors to invest in the company together or alongside with me. Okay, let's look at direct investment, and we see there are 3 main models. You've got solo investing. Okay, this is investment without any other deal. You can see the word solo, that it's done on its own. Okay, if that were the case, and it is a solo deal, that would require the most active management from the asset owner. You've also got partnership investing, okay, which involves the asset owner forming a partnership with other asset owners, or could even be sometimes the general partner as well. Okay, there we go. You've also got co-investment. Okay, under co-investment, asset owners are invited by various sponsors, could be private equity funds, and they invest alongside with the private equity fund, hence the term co-investment. Okay, here we go. Let's move on to page 8. What drives direct investment? Why would a person want to invest in a company directly as opposed to perhaps investing alongside with a private equity fund or something like that? Improved returns and managing risk. Okay, direct investment would allow the owners to direct their portfolios to exactly what they need specifically in terms of returns, in terms of time horizons, etc. Control. Direct investment gives the asset owner greater control over their portfolio. Okay, it gives the asset owner, okay, also direct control or more control over the underlying investments, as well as the information flow. Remember the word we used a little bit earlier for a typical fund. A typical fund, okay, is that what? That there is information asymmetries. Okay, in other words, the limited partner does not have a lot of information. He may wish to have more information, therefore he might decide to go for a direct investment. Cost efficiency, generally speaking, asset owners, okay, that are quite large and have reached a certain scale and sophistication can build their own teams to manage a direct investment program. And they may say, well, hold on a second, this is cheaper than going somewhere else and paying, for example, a percentage of assets under management or things like that. Most common form of direct investing is gaining popularity. Okay. However, it must be kept in mind that asset owners have increased their co-investment activities as opposed to solo. So co-investment seems to be a little bit more common than solo investment, in that you co-invest and you bear the risk together with others as well. Having said that, let's have a quick look at co-investment. Okay, we've spoken about this earlier, but let's just have a quick look. A co-investment is when an investor invests in a company, but they do so in other words, alongside another investor. Could be a private equity fund. Okay. Co-investment deals occur when fundraising is difficult. In other words, one party can't get all the money together themselves, so they co-invest with other parties and share the financing load. 3 alternative co-investing structures. Okay. The limited partner invests directly into one of the portfolio companies of the main fund. Number 2, one or more LPs make use of a general partner controlled fund, okay, that is created separate from the main fund. Okay, why do they do this? The purpose is of investing in one or more, okay, of the same companies as that of the main fund. And investments are made in what we call co-investment programs. In other words, specific investments get identified to be good investments, okay, and that's done really on a deal-by-deal basis. For example, the private equity fund may identify a good deal and say, okay, this is a good one for us to be invested in, but we need co-investment, and they may decide to select that one as being the good choice for a co-investor. Alternative 2 is referred to as what we call a top-up fund, okay, when one or more future investments is made in the main fund. An annex fund, annex is you annexing something to it, you're joining something to that, okay, is when there is a pre-existing investment in the fund already. We've got a concept called a lockstep provision. Okay, why would you have a lockstep provision when you've got a co-investment? And what that means is that it's a lockstep. Everybody can move together. Okay, where the investor GP relationship will be the same as that of the normal relationship. In other words, that nobody gains any additional benefit over anybody else. They walk lockstep, they walk together. Whatever the one can do, so can the other do as well. Okay. Okay, there we go. Co-investments may be performed via bridge funding. Okay, in other words, the general partner makes an investment in the main fund, okay, while agreeing to sell that investment at a subsequent time to the co-investors. Okay, what happens over here? The co-investors may need to get some kind of funding in between. It's called bridge funding from the main fund. Okay, from the time that the investment is made until the co-investor in fact takes ownership of the investment. Okay. In most cases, general partners charge very low or no management fees for co-investment opportunities, because remember they're now investing alongside a partner. Not very easy for them to be charging management fees. Okay, they may charge things like transaction fees, okay, but not such high management fees because they are co-investing. Okay. In some cases, limited partners co-invests by paying, okay, promote rather than, okay, and guys, when you see a word like that, promote, okay, be rest assured that that is something that can well show up in your exam. Kaya loves these words, these little bits and pieces over here that people just, oh, promote fee, oh, I know what promote fee is. Focus on it, guys. Promote is a fee based on profits, works in a similar way to carried interest, okay, but it is associated with what? specific duties. Everyone's got specifically what they need to do. If they do their job, then they get the specific fee, such as the creation and marketing of specific opportunities. Okay. When looking at co-investments, let's look at the three main fee structures. 0 fees, 0 management fees, and 0 carried interest. Doesn't seem like much fun. 1% management fee, 10% carried interest. No management fee and 20% carried interest. What you can see from over here, that in most instances, there's very little in the way of management fees. Your stock standard general structure that you would probably find, guys, with a private equity fund is what we call a 220 structure. And a 220 structure would be 2%, okay, for management fees and 20% for what we call carried interest. You can see here, you don't see 2% there at all. The most seeming is 1%. Okay. Investment processes for co-investing. What is the process for co-investing? Strategies related to limited partners include an amount between 10 and 20% allocated towards co-investment. So most of the activities are kept in the main fund. A little bit is then allocated towards co-investment. The sponsor of the main fund organizes the co-investment for the LPs. Efficient execution is critical to successful co-investing, and it requires a different skill set from the main fund. Okay. As generally speaking, the LPs require greater insight into the individual deals, which will go where and how you place those particular deals. What are some advantages of co-investing? You avoid additional fees. Okay. Remember, we said in most cases no management fees are paid. You get a good amount of diversification, because remember, you may be overexposed to a certain investment. You can now reduce that exposure by co-investing in investments that suit you better. Targeted investments, you can target investments that suit you. Dual investment review. Now the investment review process is shared between the parties. Avoiding dilution. Okay. Remember, if one needs to further invest into a portfolio company, the limited partner might get a bit diluted on account of that. Now, if he's able to follow on in the investment as a co-partner, he will not be diluted at all. Top of page 10, the J-curve effect is reduced. Remember, co-investment is generally a later on investment, so you avoid what is the J-curve? The J-curve generally in private equity looks a little bit like that. In other words, initially, and time would be on that axis over there, guys, and profits would be then on that axis. That profits tend to drop when? In the early stages. But if you get in a little bit later, you might be getting over there when the profits are likely to rise. You've got a relationship development. Okay, as a result of co-investing, okay, the limited partner may gain a foothold into certain funds that he wasn't able to get into previously. Investment upside is maximized and monitoring is improved, because remember, now the limited partner has got a greater insight into what is being done. Information asymmetry therefore would be reduced. What are some disadvantages of co-investing? There's a bit of a conflict of interest. Okay. Remember, most of it is in the hands of the limited partners, and they may say, oh, we'll keep the good investments and we'll give some of the poorer investments to our partners for co-investment. Fiduciary risk is increased. Okay. Remember, the minute that co-investment is made, it's generally outside of what we call the LPGP agreement. Remember, we spoke about the agreements before, things like the limited partnership agreement or things like that. Okay, and they may expose themselves to additional risk, both reputational and legal. May result in unbalanced portfolios and could result in disagreements between the LP and the GP, particularly when the co-investment does not perform as intended. A closing point here: co-investments require a lot of time, skill, and expertise in order to be successful. Generally, guys, we say they are riskier than a private equity fund investment. Okay, and the downside is that they've got similar downside risk to a direct investment. Okay, 235, knowledges of the challenges in co-investing. What are some of the challenges? We're looking now from, remember, the perspective of the limited partner. There's a requirement for in-house resources and expertise. Okay, the minute you've got a co-investment program, you need more time, resources, and people. Access to co-investors. There are several times that the LPs don't have access to co-investments. Okay, and the general partner may have done all the work, and all of a sudden they come to the limited partner and say, would you like to participate in this particular co-investment? And that decision has to be made very quickly. Reduced diversification. Okay, sometimes by co-investing, okay, the limited partner has just got to accept what is given to him, which might not be in line with his diversification requirements. Okay, we talk about organizational constraints. Certain organizations may have restrictions that prevent co-investing. Okay, for example, setting up offices overseas, traveling overseas, etc. There may be certain budget constraints that are put upon them that may hinder co-investments. Okay, let's look at some challenges from the point of view of the general partner. Remember, the general partner is the manager. Mostly talk and no action. Okay, generally it's not that often that co-investments are done. Okay, delay in the deal process. There are often serious time delays. Okay, to get these kind of deals done. Additional costs and resources need to be expended. Okay, for setting up specific vehicles to attend to the co-investment structure. Negative impact on relationship with other LPs. Remember, if you look at the structure very briefly here, so here is your fund. Let's say it's a normal private equity fund. The fund is managed by the general partner, and let's say is funded, let's just in this example say by 3 limited partners, limited partner 1, 2, and 3. Now let's say, for example, only limited partner 1 is invited by the general partner to invest in a new investment called a co-investment. That may seriously strain the relationships with the other 2 LPs. They want to know why were they not invited. It could become an exclusionary process. Just watch for that. We move on. Okay, 236. Okay, let's talk about the historical returns of co-investment. Has co-investment in fact been profitable? Let's have a look over here. Okay, the evidence of underperformance may be related to the fact that what we've spoken about earlier. They are higher risk deals. Okay, there's a large difference in performance between solo deals and co-investment deals. Okay, and why might that be? Okay, could be related to a potential conflict of interests and a principal agent problem. Okay, resulting from the GP selectively offering deals to the LPs. Remember, the GP may not offer the best stuff across to the LPs. They may keep the good stuff for themselves and offer the LPs not the best deals to co-invest alongside. Other studies show that what buyout co-investments and VC co-investments outperformed corresponding funds. Investments generally have lower costs compared to other. We said that because there's a lower management fee. Okay, and we say there's no evidence that GPs offer them lower quality deals. Okay, we see over here a further survey regarding the top 3 reasons why GPs may offer limited partners a co-investment opportunity. 1, to build a better relationship, to gain access to additional capital for deals. They're now able to, general partners are now able to do bigger deals, and to improve the chance of successful fundraising. Capabilities required to be successful in co-investing. You need to build internal expertise and staff. You need to source your own co-investments. Efficient approval process. Try and get the process streamlined and not to delay too long. Co-investment program risk management. They needs to decide, for example, they need to manage the risk by deciding on things like the size of the allocation towards co-investment, where the sources will come from, etc. What impact does co-investing have on the J curve? We spoke about that earlier. It generally tends to mitigate the J curve. Why is that? Because capital is deployed immediately, okay, and investors avoid paying many years of management fees on their commitments before the capital is employed. Looking at it from another point of view, perhaps co-investments can make the J curve worse, okay, and why would that be? As a result of deal selection exposing the LP to a wider range of outcomes than investing directly in a fund. What would that be? Some deals have distribution profiles that are back-ended, okay, and being back-ended, what would that require the LP to do? To make further investments again and again before any distributions are received, and again as they make more and more investments, that would just exacerbate the impact then on the J curve. So we see two different looks at the J curve. Okay, that then brings us to a conclusion of reading 2.3, accessing alternative investments. As mentioned earlier, it does appear to be a new reading, but if one looks at it now having gone through the particular reading, what would you probably tell me? No, this is really an old reading from private equity, nothing new here. On page 13, guys, I hope you can see over there, we've got the edge checkers. What are they there for generally? Just make sure you can do the questions after you have gone through the particular reading. That'll give you a sense that yes, I'm aware of what went on in this particular reading. There's 7 questions for you there. The solutions are on the next page for you over there. And what I always tell candidates is when you are finished reading a reading, like for example this one, reading 2.3, take yourself back. Let me do it with you just quickly to show you how I like to do it. Take yourself back to the beginning of the reading and say to yourself, well, on the front page, why did Edge Designations reprint all the learning objectives for me on the front page? Because they were looking to bulk up their notes. No, that's not the right answer. Edge Designations did this because it's always a good thing, first and foremost, to see what's in your reading, but also when you finish the reading, come back to the beginning of the reading, guys, okay, and now say to yourself, let me go through these. Do I know, okay, what's in it? So let's say, for example, let's start. Identify the primary characteristics of an open-end fund structure. Think to yourself, what are some of the characteristics of an open-end structure? Remember, nothing learned off by heart, guys, okay? Because it's not that kind of exam where you have to know things off by heart to be able to write them down. You just have to understand what's in there. But do you know some characteristics of open-end funds? Okay. Do you know some characteristics of closed-end funds? Okay. What is the difference between an open-end and a drawdown fund? Now, if you don't know the answers to these, then you haven't taken in sufficiently to be able to answer your car questions from this particular reading. A good suggestion then would be either to re-watch the video, reread the notes to make sure you've got that under control. Okay, this then brings us to a close of reading 2.3, accessing alternative investments. Topic 2, intro to alternatives, and reading 2.3.